Hello, everybody, and welcome to the VC panel session. My name is Michael Bruq, and I'm very happy to be moderating this panel today. I hope everybody is ready to go on. So we have today four people who will be joining us and giving us their views from various perspectives on investing into the fintech sector, in particular during these times of COVID, which has changed the situation quite a bit. And we'll be exploring the various aspects of that. We have Alokik Advani from 8 Roads Investments, Eva Law from the Association of Family Offices, Kapoor, Fosun Capital, and then Bonaventure Wong from Arabian Asian Investment Company. What I'd like to do to get started is to let everybody give a brief introduction of themselves, and then we'll go into the Q&A. So how about Alokik, you going first, and don't forget to unmute yourself.
Thanks very much, Michael. Firstly, I'm very happy to be here. Thanks very much for having me. My name is Alokik Advani. I manage the FinTech strategic investing team at 8 Roads. 8 Roads is proprietary capital backed by Fidelity, the large global asset manager. And our job is to look at investments in the fintech space wherever there's some strategic angle back to Fidelity's international businesses, essentially outside of the US. So we look at the fintech space across Canada, UK, continental Europe, and all of Asia Pacific. We set up this team in Q4 of 2018. We've made 8 investments thus far, deployed north of $50 million of capital, and continue to do so. But our reason for being is twofold. So we look for strategic impact of Fidelity International, and we look for financial returns. We usually start with minority stakes in early stage companies, Series A's and B's, but given Fidelity's sort of key focus as a wealth and asset management company, we tend to keep those themes in the center and look at other things that sort of touch it around the periphery. Things like capital markets, direct tech, AI, blockchain capabilities, robo, digital distribution, etc. So very happy to be here. I'll stop there. Thanks very much for having me.
Thank you very much, Alokik. Eva, could we have a bit of an introduction from you now?
Sure. Hello, everybody. It's Eva. I'm from Association of Family Office and also from ACIC International. The association, actually, we gathered many single-family office, multi-family office, and some other institutional investor. And then we normally do 2 things, facilitating the club deal among these very close circle. And we also, through our technical committee and our specialists, to offer advisory services to the family offices and maybe the solution provider that serve the family office. While ACIC International, it's a company that we manage direct investing mainly in 2 areas. One is real estate, the other is fintech. And in recent years, actually, we see more and more money is actually pulling and allocating into fintech and some other technologies, not just financial technology. And then we always, as a manager and club deal facilitator, through direct investing into many fintech companies. So that's my brief introduction.
Thank you very much, Eva. That was very helpful. Tej, how about giving us the view from India?
Yeah, thanks, Michael, and great to be here among all the really experienced investors here. So I represent Fosun RZ Capital. We are a global fund. We are about 1.3 billion assets under management. We invest in China, India, US, and Israel. In India, we have started our practice in about 4 years ago. Now we have total of about 16 portfolio companies, and out of which 4 are fintech companies. As you know, India has been doing extremely well in the fintech segment. A lot of opportunities are coming. As a matter of fact, we closed one of our deals in the COVID period. It's a company called .Pay, which we closed. So fintech has been a has been a great sector for us in India, and we're super keen to invest more. And also, we started looking at Southeast Asia, particularly Indonesia recently. Like Alokik, we do Series A, Series B investments mostly, and occasionally we'll even do seed. So we're looking for good entrepreneurs who can pitch their ideas. We are happy to back them up. And Fosun, as you know, is a large group, so we can support them through their journey if they want to raise more money as they go forward. And glad to be here and looking forward to the discussion, Michael. Thank you.
Thank you, Taj. And last but not least, as we go around the world of our panelists, I think quite literally we're spread all over the world, so it feels like in around the world in 180 seconds. I'd like to ask Bonaventure, how about giving us a brief intro to AAIC?
Thank you, Michael. My name is Bonaventure Wong. I'm the managed partner at AAIC, an asset management focusing on Asia and Middle East and North Africa corridor. We currently manage about $2 billion with an ESG overlay with all our investment. Currently have a TMT fund focusing on investing with a fixed income return. A little bit background myself, I worked for JP Morgan and a sovereign fund in UAE for the last 25 years. Fortunately, also sat on the family office side as well, managing a family's $10 billion asset. And then, of course, with my startup experience, I founded 3 telecom-related companies as well. So I've got a little bit broad view about the fintech and as well as from an institution as well. Thank you very much.
Thank you, Bonaventure. So I thought that maybe we'd get started kind of looking at the bigger window, bigger picture over here, sort of globally. Alokik, I wanted to kind of get your views in terms of, first of all, if we look at the global trends, depending who you look at, but according to FT Partners, who tracks deals, they've reported that fintech and financing in the second quarter have been about 9.3 billion, which was the lowest since the beginning of 2018. So whether this is just a temporary blip or a long-term trend, I'd be interested in understanding, getting your thoughts. I mean, is this just a function that funds are holding back dry powder to make sure that they have enough for their portfolio companies, in which case it might just be a shorter term aberration, or is this an indication of something that goes on and will be around a little bit longer?
That's a good question, Michael. So firstly, let's play the timeline a little bit, because I think it'll help frame some of the context. If we go back across 5 months, when everyone went into lockdown first in March, some point in March or early April, I think all the funds spent probably a month or so kind of battling down the hatches and just kind of making sure that their portfolio companies were well positioned. They had the right revenue opportunities in front of them, though they might have been delayed, but most importantly, what was the cash runways? What kind of cash positions they had, what kind of burns they had, how were they able to sort of lend in those periods? I think coming out of that, the other part has been, and something that we were just talking about in advance of the session starting, people have been getting used to investing into companies without meeting people face to face. Now, I think some of that is happening, but a lot of them are based on long-standing relationships. You may have met this company a year ago, 2 years ago. You're sort of rekindling some of that and moving that forward. But I don't think the last quarter is probably representative more of a sudden halt where people went in and looked at their portfolio companies. But I think we've seen a pretty healthy trend of companies getting funded. I think there's definitely a barbelling of good versus others, where you see some of the money flowing into, but there's no shortage of funding coming into the market that we see. I also think that over the next 3 months, we might see some of the exhaust coming off of, people holding back over the last quarter. But from our own perspective, we funded 2 different deals over the last quarter. One into a new company in the RegTech space called Stili. The second, a follow-on funding into our flagship investment in a company called Moneybox. Moneybox also raised one of the fastest crowd funds we've seen, where they raised £7 million in 2 days. So I think we're not seeing real shortages of money coming into this space.
Thank you. I was actually also wondering, in the same FT partners report that I saw, they had a chart in there that shows that the amount of new money coming into lead rounds has went down a little bit, but then has been climbing again. And I'm wondering, is that just because, you know, best practices in a fund is you want to get a new lead in order to set the pricing, or is that we're not clear enough in that chart in terms of whether it was that effect, or was it actually new money coming into, you know, new players coming into the space? Are you seeing that happening?
So I think we've seen both. Honestly, where there's been a real need and a financing need, it's usually the existing players trying to get that done quickly. It's also funny when you read some of the news articles coming out on TechCrunch or otherwise, it's quite clear when they don't mention who the investors are, where the money's coming from. So I think it's a combination of both. I think you're seeing both sides of that coin.
Thank you. So let's take a step back from sort of the more institutional side of the investing and look at the family office perspective. So I'd like to get Eva's views on this, because family offices typically have a multiple agendas, I would say, unlike a straight institutional investor, although in Fidelity's case, there's an absolute return as well as something that's strategic to Fidelity's case. But a lot of funds that are backed by institutional LPs simply look at the bottom line in terms of what their IRRs are. But family offices typically have additional considerations. So they're, you know, they have a longer time horizon. They're not looking at returning capital to LPs. They also have social, environmental factors. So Eva, I was wondering in your perspective on that, and in particular in how it relates to today's environment and as well as fintech.
Okay, I think many of the family has created a wealth by building business themselves. So it's always makes sense that they would like to leverage their experience and also invest and grow their operating business. So family office would like to, invest into fintech that can really, that create values for their family enterprise. For example, within our network, many are the developers. So the next gen or even, the first gen actually are very fond of investing into PropTech. So that's how they actually pick, the technologies that they want to invest into. And they believe that they have the proprietary knowledge that will also enhance the likeliness of success for the investment. And in terms of the investment horizon, I think family office is a bit different from other institutional investors, particularly those VC or private equity managers, because family offices are not under pressure from outside investor to exit the deals. So while private equity firms typically own their investment company normally for 5 to 7 years before cashing out, but family office can actually hold the investment as long as they need to. And they don't have a very explicit time horizon that like other private equity firm does. So the money, it's sitting there and can hold on to money for a longer period of time.
Are you also seeing any trends or any differences between family offices mostly investing closer to home, or do they have a more of a global perspective and are interested in investing outside of their home territory?
Actually, they quite flexible. I see, many of them investing in their home country. But many of them, also, actually have cross-border acquisition as well, and for their forms of investment is always in a direct investment model, rather than a employing a fund manager investing into a basket. But of course, there is an option, available in the market that they will allocate money into this kind of portfolio. But talking about the size, the substantial money go direct to the direct use. So that is always the format. And also I would also comment in terms of being a financial investor, actually family office or the family enterprise is also like to invest into technology company, okay, to actually enhance, okay, their competency of their house and the business. So it's not just okay about investing into okay a particular company, just expecting that company generate alpha, but they would like to leverage that kind of direct investment and the inferences or the proprietary information that they can get access to through holding these kind of investment, particularly through majority stake control, okay, that they can really use the talent within that technology company that can really enhance the business. That's what I learn, okay, and see that is how they will pool the money into these kind of company.
Thank you. That's actually very interesting. So I think at the next direction we're going to look at is India, which of course this is your bailiwick, Tej. And as you said earlier, India's, I think, especially interesting given the rapid changes that have been taking place. It's really been probably one of the quickest transformations in terms of going from traditional to really deploying technology. And a lot of it has to do with the government, of course. I think there's been the things like the identity, data identity, the banking inclusion, demonetization, and on and on. You'll get into more details on that. And of course, then you look at the companies like Jio, which people are talking about because their role as well in terms of digitally connecting the whole country really establishes an interesting infrastructure for transformative innovation. So how do you see this developing, and how do you see the interplay and the balance between what the government is doing to set essentially an industrial policy, an economic policy, together with the private sector, which you're more representative of, as well as sort of being a foreign player in all this? And we'll get more into the global aspects later, because that's a whole topic of its own.
Yeah. No, thanks, Michael. And like you rightly pointed out, I think one thing I can have a one-up on my Chinese colleague is actually the fintech sector. And we have UPI, which, by the way, just to give you some numbers, they did 40 billion worth of transactions last month, 1.4 billion, 1.4 billion transaction and 40 billion worth of transactions. So it's phenomenal. Wow. And I, like you said, just rolling back, just a few years ago, I think there were 2 or 3 things which I really want to highlight, which, changed the game for, and I've been investing in India for about 10 years. One was the UPI was a big game changer, where all the banks came together and said, we will not charge any fee for people to transfer money, which I don't think has been done in any country, of significant, any large country, because, in China, as you know, Alipay has its own ecosystem, WeChat is own, they don't talk to each other really. Then I think, like you mentioned, Prime Minister Modi with his the banking program, where he got a lot of people into the banking, remit, was also rolled out in his first term, which got a lot of people into the banking. And third, as you all know, is Jio, and Jio with their scheme of giving free internet to the nooks and corners, which changed the game. So India suddenly went from a very data poor country to a very data rich country, and all these 3 were sort of the enabling pillars to it. So all credit to, like you said, the government, and then the private enterprises, particularly Jio. You need a market mover, and I think we all know Mr. Advani can move many markets. So here he was, as a result, what has happened is there are a lot of innovation that has been happening. If you look at H1 2020, India has, Indian private investing has raised about $4 billion US, out of which 1 billion and again gone into fintech sector. And there, if you take lending, if you take wealth management, if you take savings product, if you take player like credit card based products, everywhere there is so many opportunities to unlock, which are all running off these rails, which were put into place by things I just mentioned. On top of it, I think we all know while we were in the shutdown, Geo raised $20 billion US, which by the way was equivalent to the entire money raised by the VC industry last year. So I think the lockdown was really helpful, and things were buzzing at Reliance. So that's going to further unlock, Michael. I don't see that as a bad thing. I think it's a very positive thing. I think it's going to really, really unlock another layer of, he wants to take a lot of the offline grocery online. Like I was mentioning, the investment we have made in a company called Dot Pay. They are doing contactless ordering. So COVID is another big, demonetization was a big push towards the digital payments. I think COVID has done that to India again. I mean, it's very bad for some of the offline, retail, restaurants, etc. But for lending and fintech and any sort of, any gamut of fintech play you are in, you are benefiting. India has also seen the growth of largest demat accounts to trade on public markets ever, in last 2 to 3 months. So overall, I think this is a great, COVID has thrown a great opportunity. Obviously it's struggle, but a great opportunity. Remittance businesses are also rethinking, even as the migrant workers are going from one place to other. So we can talk a lot more, but I see this as a positive for fintech industry in particular.
Yeah. Well, we'll come back to that, because I think the last decade we've seen, sort of China taking the lead in terms of technology and payments with Ali and WeChat Pay. And, it really is beginning to feel like India is going to be the story of the next decade, because the infrastructure that's been set in place, coupled with an amazing talent pool of technologically capable people, the engineering and entrepreneurial spirits. So I think that's going to be a very, very interesting place to play. And
super exciting.
Very, very exciting. Let me move on now to Bonaventure and kind of take the conversation a little bit back to sort of family offices, since your asset management firm is focused on that. And the question to you is, do you feel that the family offices have the right skill sets to invest in sectors that are new to them, obviously like fintech being one of those? How do you think they should be looking at the investment process based on, in terms of the portfolio, in terms of sector, check size, which round to participate in, geographic coverage, stage of the company, et cetera, that whole thing? And is this something they could do on their own, or should they be looking for help in terms of how to navigate that?
Okay. The process.
This is for Bonaventure. Sorry.
Okay. Yeah.
Since we have to give him a chance to speak, but you have to get off mute.
Yeah, I'm off mute.
Sorry, Eva.
No problem. Thank you, Michael. That's, yes, I think the family office and the questions about the process, not only the family office, but the VCs itself, they're mostly focusing on their portfolios. So family offices are already invested in fintech. They're going to be putting more time and resources to help those that are in their own portfolio. So that's a good sign, I think. But then it's the negative sign of it is that seed money, early stage, has slowed down dramatically across the board. We've seen a huge decrease on that. The reason is because of the actual, limit, aviation being locked down, airports being locked down, visiting and such. But I think overall, the due diligence process of these investments have actually shortened than ever before. I think that's pretty exciting, using the technology as we are doing a virtual, a lot of these due diligence are done virtually now. Sequoia even did a walkthrough a warehouse all on a phone camera and invested $20 million. But of course, what that means is that, for someone like Sequoia and anyone else, institution, we do see a lot of B and C round funding itself. So for our family office, and also for our TMT fund, we've actually been focusing on the debt side of it, mezzanine convertibles, because that really puts in perspective some kind of return in a very short period of time. I think family offices are looking for that. Less of it's just straight equity. I think valuation has always been a gap between the investor and the actual company itself. But since even the seed investment back to seed investors has slowed down, I saw that a lot of accelerators has actually increased in application for 4 times than last year. So has the money moved towards those kind of, looking at pipeline deals through these incubators itself? So.
Thanks. So I'd like to actually pick up on a point that you just mentioned, Bonaventure, and Alokik, you did as well, which is the ability to close investments effectively virtually. I'm looking here, we have about 100 people already on this call, and I'm sure some of them are entrepreneurs or leadership of companies that are looking to tap into the market to get more funding. Are there any examples that you could give of things as advice of what works, what doesn't work, because we are in the kind of a new world relative to how people pitch and how they do due diligence and go through the entire investment process? So I'll kind of open this up to whoever, since maybe Alokik, you mentioned this first, and Bonaventure you did as well, but one of you can take the first crack at this. Words of advice and wisdom from the investor's standpoint to the companies that are looking to you to get your investment.
I'm happy to start, and then I'll turn over to Bonaventure. Look, I think the hardest part about not being able to meet people in person is the trust element. How do you build the trust virtually? Right? And you can have enough phone calls and enough Zoom calls, but you need to build that trust and belief when you look into someone's eyes and believe they're going to build this business and make it a success, right? So the advice to the entrepreneurs is a few things, right? One is be really, really authentic in your pitch. Don't come too scripted, don't come too canned, don't come too prepared, but just be authentic in your pitch and what you're doing and your passion for the space. I think the second one is really, really know your stuff, right? Whether it's your total addressable market, your numbers, your reason for being, what pain point are you solving, etc. And if I think about third is get it across in the most coherent and simplest manner, because you don't have 80 slides and 3 meetings to go through before you're going to get it across. So get it across as crisply and coherently as you can. I think those are sort of simple points, but I think they can probably resonate because that authenticity needs to come across, and the belief in the individuals needs to come across, especially when you look at early stage deals like we do. So.
Good advice.
I totally agree to Alok about that. I think also important that we as investors tend to look a lot of opportunities. So we kind of a little slow in getting, so it's important you do get it across to us very quickly. But I do see hopes there. I mean, these, forcing us all to look at a different way of investing has given us the reason why we're doing this, especially this webinar, this event virtually, and all these investment side. But I do think this will continue for a bit, and it might continue for much longer. It's just, we're very comfortable doing Zoom in any of our meetings than getting on the plane. From an ESG point of view, for us, it's pretty good. We can save money. We no flights, hotels. Well, hospitality might go down, but from a fintech, I think technology has really have proven themselves yet again.
Okay, that's very, very, very helpful. Thanks. So at this point, I'd actually want to sort of step back and look at a thing. I guess it's kind of the elephant in the room in a sense, because what we're seeing, we talked about, the different regions, and it feels that it's more than feels. I think it's a fact that the world is backing off sort of from its globalization and free flow of investments, and although funds are very often regionally focused, but there are new concerns that are coming to the forefront, like national security, data sovereignty, and of course the COVID-19 situation has just accelerated that trend. And there are differences already taking place. China has got its own payment systems with WeChat and Alipay, and now India is about to emerge as a major new digital infrastructure payments. And there's been a recent paper which we were talking about before. The strategy view of the 4 internets. U.S., China, India, the rest of the world, sometimes referred to as a splinternet. So if you're looking at it, and this is a question for all of you, but we'll take it in turn. If you're looking at investing, so for example, Ted, you're working for a Chinese fund investing in India, and there's also corporate investors. So you're an institutional investor, but you've got Tencent and Ali and Google and Facebook, pretty much many of them who invested in Geo. what are your thoughts about this? How is this going to change the way investment takes place? What are the sort of good and the bad that you're seeing out of this? So it's a bit of an open-ended question, but I thought we'd get a bit of a discussion going on this. So I don't know who wants to take this first.
Sure, I can start, and then we can. So as you rightly said, Michael, there's obviously a anti-China sentiment that has set in, and it's become a little difficult to invest in India for Chinese investors. You have to go through government approval process, which just creates a bottleneck. But rightly so, the Indian government wants to know where the money is coming from, and we follow that process. So we have one of our investments which is waiting in the process right now. So and there was a great connect that was building between China and India. There was a lot of participation from Alibaba, Tencent, as well as Fosun, and more than that, there was exchange of information between the Chinese entrepreneurs and Indian entrepreneurs. And I think India sort of relates more to China in a way that from the scale point of view, because US has 300 million people, but obviously there is the geopolitical tension which always remains between India and China. So that plays really badly into what tech entrepreneurs would like to see, is more participation. So I think both sides of tech entrepreneurs want to work with each other, and I think once things calm down on the border, then hopefully we can revive some of that. Maybe not at the same pace, it might be a slower pace, but I'm sure we'll figure out a way to work with each other. On the other side, with the US, India has always had a superb sort of connect, especially when it comes to the tech side. All the top CEOs, as Satya, or at Google, Sundar Pichai, and all the tech companies have top guys who are Indian, so they automatically sort of understand India. Maybe they left India 15 years ago, but it comes naturally to them. So it is very I don't see. Google announced they're going to invest $8 or $9 billion, out of which 4 has gone to Geo, which every startup guy is saying, why did that happen? It should have come to us. But I think so. Everybody's looking at these big guys, the big 4 tech companies out of US to invest in India. So that's going to continue, and which is a great news. And some of the Indian companies, unfortunately, a lot of unicorns that we have do not make money, right? Or versus China, where Ali and Tencent were like profitable. So we don't see a lot of acquisitions of smaller companies. I think that might change in about a couple of years when some of the Indian companies get profitable. And also there will be, if you look in the future, there will be some relationship with China, which will be there. So I think Indian entrepreneurs are sitting in a very sweet spot, because everybody knows that India is the next big market. And that's why, I think that will cut across the borders in different way. Obviously, everybody is becoming more nationalist, as you were saying. So there will be more. I mean, all the ministers in India have said it very loud and clear, including banning TikTok, etc., that the entire data has to be in India. So there is this nationalism that is there, again, rightly so, that if it is my country data, why should it go out? And I think we are seeing that in Europe as well, in US as well. So that will continue. I think it's tech wars. Everybody wants to have the biggest tech games. I mean, it's no longer war with bullets. So everybody wants to own the best tech in the world. I personally believe India is sitting in a very good spot to take this next 10 years with the talent you mentioned, and the money supply that we have to grow. So some of this, they will play both, in my opinion, to get the best for Indian market.
If I may add to that, I think there's a slightly sort of larger perspective, I think, which is important here, right? Which is, as you were mentioning, sort of the 4 ways of the internet for now: US, Europe, China, India. I think if you take the sort of the impact that the US has had on inbound investment coming in through their CFIUS rule, I think that's going to be interesting, and seeing whether similar types of regulation will arise in different countries to sort of further the protectionism. I think beyond that, the other elephant in the room that people aren't talking about is the is kind of the Senate hearings that took place in the US, which were the four big behemoths, and everyone touts them as the models, were being held to task on data, on protectionism, on anti-competitive efforts, etc. And there's a huge push from several different parts of, good or bad, or will happen or not, to kind of break down some of those businesses and the dominance that they have. And so I think that if you look at that impact from the US side of it, and then the China impact with Ant, Tencent, Ali and others, there's the pressures coming from both sides with these behemoths and kind of trying to dominate different parts of the equation. I think to the point that Tej was making, the India unicorns and decacorns aren't quite the same size, scale, and strength from the other countries yet. And in Europe, you've seen limited amounts of those companies being created. But again, nowhere close to size, strength, or scale. So I think there's still more to be played for here. But I do think there will be regulation driving it, and largely driven by data privacy concerns. Europe is very much at the forefront of that data privacy angles, whereas places like China are still completely open data within the walls of the country, right? So I think you have a sort of views that sort of split up, where in one way people are trying to think about, is it a service I wish to do, and what is the data implication of it? Or in another context, the data implication is irrelevant because the service is providing me with something that I didn't have before. And I think those two arguments are what's going to drive some of the proliferation of fintech. I also think the fintech angles that have been really interesting is in the middle of lockdown, fintech and the use of fintech products have only gone up exponentially because no one's using cash of any kind for anything, right? So they,
except for Hong Kong, I have to say.
Yeah, for payments, for automated, remittances, transfers, I mean, whatever it is, you couldn't go into a bank, so you may as well do it all online, right? So I think that's, and mobile. So I think that's the part that's getting a lot more traction. And so it's one of the industries where you can see whether it's payments, it's lending, it's wealth, or insurance, it's all booming because people are doing stuff and they have time to do it because they've been locked down for 5 months.
Yeah, it's interesting what you're saying. There's so much irony in the fact that on the one hand, the U.S. is lamenting that they're, being outcompeted and losing leadership in certain technology sectors, and at the same time, they haul the 4 most successful companies in for hearings and beat the crap out of them. I mean, that's like, I'm sorry, it's a very schizophrenic way of looking at it. So you want to be successful, but don't get too successful, or you're in trouble. So one of the other things I wanted to dive into, and I know we're running a bit low on time, we've got about 6 minutes left, is we've talked mostly about India, the US, and China, of course, but I'd like to touch real briefly to get a perspective on, for example, Bonaventure is based in the Middle East, and also Tej, you mentioned Southeast Asia. Your thoughts on those 2 regions, because we haven't covered them, and since we were trying to get around the world, at least get a global view on this, I wanted to get your thoughts. Bonaventure, anything that you're seeing that's interesting in terms of development in sort of Middle East, North Africa area?
Yes, I think for us, because we kind of concentrate on the Middle East, North Africa, and Asia corridor, specifically Middle East and Asia, there has been kind of investment strategy has been looking at cross-border more to kind of diversify asset allocation, not only the asset, but also jurisdiction as well, because they're seeing the emerging market as being the biggest, and looking at India and China growing. These are the 2 biggest markets. They're in those regions. So for the Middle East investors, they don't invest. Even you look at the sovereign funds, they are about 2%. This is a big thing for ADIA in investing in geo in India. That's a huge, allocation of their portfolio into these regions. Family offices around this region, I mean, they're very liquid. It's just that don't have opportunities. And that's the fault of our, investment banking distribution channels, is that they've been, Middle East has always been looked after by the European office or the New York office. Asia has always been looked after vice versa, their own regional office, and they don't have presence over the Middle East. So deals that cross border those regions tend to end up with the worst deals that no one else wants in the rest of the world. So I think that's the opportunity for a lot of the entrepreneurs and fintechs, is to look at these markets, because they are the fastest growing markets now. and especially the Islamic fintech is quite exciting to look at. So it really bridging that and bringing the capital across to these opportunities is really the key factor here. So yeah.
Tej, any thoughts about Southeast Asia since you mentioned it earlier?
Yeah, Michael. So we keep it short. I think just started looking at it. Indonesia seems to be a clear scalable market among all the players. And I just want to sum it up in a way, you know, I feel like a Chinese when I go or look at Indonesia businesses, because now I feel how Chinese feel when they look at India, because the size is so small, right? So when you look at them and you say, oh, you know, you don't have Paytm of India, or you don't have this on it. So there's a lot of, again, talent is a problem in Indonesia. A lot of Indians are going there. A lot of Chinese are going there and creating businesses with local partners. So I think the good news is the GDP per capita in Indonesia is double of India. So you could, and actually there are some scalable companies which are profitable. You know, a couple of them are getting there, so they can acquire other companies. So, but yeah, nowhere scale of India or China, but very interesting markets to look at.
Just a quick observation on Southeast Asia, Michael. I think the interesting part I feel there is, like the proliferation of fintech in every country around the world, it starts in payments and lending and then sort of proliferates from there. I think the next wave to come there, sort of wealth and insurance, is going to be really, really interesting. I think starting with some of the more basic products that have worked in other geographies. I think the other part, you do have, besides the behemoths coming in from other countries, you have the local behemoths of Grab and Gojek, and Grab just announced 3 new financial products. So it's kind of interesting to see the, you know, sort of how are the upstarts and new startups that are going to come up and try and take space in those places when you've got some dominant and sort of new incumbents as well.
Thanks. I think we have about 3 minutes left, so let's see if we can get through this one. I mean, one of the areas that I think come where sort of the more traditional institutional funds and family offices might have opportunities to do things together is in the area of sort of family offices that also have a traditional business that they're looking to create more digital, essentially move it to the digital world, digital transformation as is very often called. And there are various ways that they could do this. You know, they could develop a CVC model where they have their in-house investment vehicle, in-house accelerator, and you know, at some point as the business grows, they may want to bring in institutional investors to fund the growth of this business. So I was wondering if anybody had some thoughts in terms of which model they believe worked better if you're a existing business looking to deploy capital that also has a strategic element to this for their own business, and then at the same time also put it up so that it not only benefits the business but could also generate some nice return through an exit, which usually means you do want to bring in the institutional investors.
I'm happy to start there because that's what we do.
Okay.
It's sort of interesting, right? Because I think that each investor needs to sort of figure out what they're bringing to the table. I think this is what we advise every startup, that when you're looking at raising money, you can raise money, and then if you have choice, then you've got to decide who's bringing something for you. What are they bringing? Is it access to different geographies? Is it access to different kinds of clients? Is it access to technologies? Is it their experience of building up companies, helping to exit them? Or is it strategic linkages as well? So I think the key part that's important when you have strategics come in different ways. And when I say strategics, it's not so much like, you know, just a corporate coming and putting money, but someone who's a thoughtful strategic investor. Coming in is are they able to bring more than the capital, and how are they able to do that? Do they bring in real domain expertise? Do they bring in experience in particular geographies, etc.? But I do think it's important alongside some of those sort of CVCs to also have other institutional investors, VCs, PE type investors along different stages. Because they're bringing different aspects to the companies. So in almost every deal that we do, even though we may be the first institutional money and we'd like to syndicate some of that either in the same round or next rounds, and we also co-invest alongside other institutions as well. So I think that balance is really healthy for some of the companies, because to get the strategic angles, the financial disciplines, the experience, domain expertise across different types of investors is hugely powerful.
Thanks. That's interesting. Any other thoughts from any of the other panelists on this? Eva, Bonaventure, since you both work with family offices as well.
Yeah, I can add to that. I think the family offices, they do have the lack of understanding a lot of the fintech areas, sectors, and I think that's where a lot of opportunity to help these family offices to kind of bridge that across through. I think accelerators are a good way for them to plug in and look at that as a very early stage. The bigger family offices will be able to go to the BEC round. But they're never the anchor. There's always someone, institution will kind of come bring that along. But we do see a big change. These family offices are getting bigger. They're getting, they're hiring people with the expertise. And I think more so now because they saw that in how, especially the technology and fintech, as Alok said, we're using more of our applications, mobile, has fueled that this is where we should be putting our money. They're not leaders, they're always the followers. And it really relies on institutions to be the leaders, understanding where the market's moving and such. So those are the good things and the bad things. And yeah.
Okay, thank you. Well, it looks this time passed very, very quickly and we have hit our time allocations. So we'll be in the lounge for anyone that might have questions in the virtual lounge. So thank you all of you for this. It looks like we lost Eva, so but for the three of you, Tej, Bonaventure, and Alokik, thank you very, very much. This has been very, very interesting, and we'll talk again soon.
Thank you, Michael, for hosting us. And so much.
Michael.